Welcome back. We're right there, almost like, the tick is pasted on the tape. I mean, 370, 380 lower, 25,800, not budging so far. Incrementally, that is. Sunil Koul is Asia Pacific Equity Strategist at Goldman Sachs. Sunil, good afternoon. Good to have you back on the program. Thanks for your time.
Glad to be back.
Two things, right? One, of course, is a lot of talk of whether tactically money is moving to China. Is that at play at all? What are you hearing from your regional desks, if you can? And second is, we just thought this large cap rally was starting, you got what you got today. How would you look at it? I mean, I think about 40-50%, maybe more of large cap stocks. I mean, Nifty stocks are just about 10% away from all-time highs.
That's true.
Just your thoughts. Yeah, go on.
Yeah, Prashant, I think on the China bit, I would say, look, I mean, the fact is that they are seeing a very coordinated response on the policy, both on the monetary side as well as on the fiscal side. I think from some of the client conversations we have been having last week, including some of the flows from the desk, I would say people are a little bit sort of skeptical about China on Tuesday, when we had the monetary easing announcements by PBOC in there. And I think the tone at that point was that you need sort of more fiscal push for growth to stabilize. And then I think on Thursday, we actually had the Politburo meeting wherein they sort of pledged to have more sort of fiscal support. And then there were some media reports which are still unconfirmed, but saying that there could be as large as 2 to 3 trillion RMB stimulus, which could come through in terms of recapitalizing the banks, sort of consumption stimulus, infrastructure stimulus. So I think so I think the clients we have been sort of speaking to late last week have been also sort of getting a little bit more comfortable with the fact that if this indeed comes through, it could mean sort of stabilization in China growth, which should be good for the markets overall. Having said that, I think the market had a very strong rally last week. MSCI China was up 17% from the lows. But I think if you put that in context, we had the market coming in from deeply oversold levels, right? I mean, we were seeing valuations at 9 times China in China, and now that's kind of gone from 9 times to 10.5 times. So we still think that it can sort of go to sort of 11 times plus. And so there could still be a bit of tactical rally continuing in China. Positioning from what we are hearing, both from long onlys, but also from the hedge funds, long short managers, is that things have kind of gone from positioning in the bottom half of the decile to like 14-15% in terms of the overall positioning, but there is still some more room for that to improve. So I would say I think you could still see next couple of weeks China momentum continue. The critical thing would be to see whether there is any improvement in the higher frequency data for the month of September, which comes out in the middle of October. So I think in a couple of weeks, the market will start to see if we are seeing some stabilization in the data.
Throw in India there as well, in terms of that feedback. Sunil, point taken, but throw in India into the mix there as well, in terms of flows and what you're hearing. Is it, I mean, so if China momentum continues, does it have to be at the expense of some selling here? Will it be? What's your sense?
So far, we haven't seen, Prashant, anything like that in the data. I mean, last week, I mean, there was kind of flattish flows in India, even though kind of China had a very strong rally, as I mentioned. I would say a couple of things. One, if you just historically went back and looked at China's flows correlation to the rest of the markets, even during the times China has had strong inflows or over the past sort of 10 years or so, I think there is generally a positive correlation to most of the markets in the region, meaning that when there is kind of decent backdrop for the overall region, you start to see flows coming back everywhere in the region, including China and India as well. So I don't necessarily think that flows, therefore, is a zero-sum game, that China inflow means that you have to have outflows from India. I think a large part of that should be based on underlying fundamentals. The other sort of anecdotal or more sort of historical episode I will point to, I think we had 2 recent episodes somewhat in terms of very strong rally in India. One was a rally in China, One was in January this year, kind of January to May, that 4 month of rally. China was up 30%. During that time, I think India had less than $1 billion selling in terms of FII outflows, and the markets were still 10% higher because of the domestic flows. And then obviously there was that late 2022, early 2023 China reopening rally, which was kind of a 60% bounce in China. Even then, India, I think peak to trough was only less than 10% down, and then quickly bounced back in the next 3-4 months. So I would say that in general, our sense is that India probably still stays resilient overall. You might see a bit of weaker foreign flows, which is not just because of China. You also have US elections coming up. You have state elections in India. So there's lots going on, because of which you could see kind of tepid foreign buying in general. But our sense is that you probably will still continue to have support from the domestics, and overall, because fundamentals still look decent, market should be able to hold its gains.
Now, just to complete that point on flows, while your point on passive flows is very well taken, right? And we've had a lot of guests who've been saying exactly this. We were in conversation with Mark Mobius earlier. So the point on passives is fine, because that money will come into emerging market funds. It will come to India also. But what about active fund managers? And this might not start just yet, but what's the chatter you're hearing? Is there some sense to book profits on the active side? Book profits in India, where the markets had a roaring rally, and tactically move that money to China?
Look, there could be a bit of that rotation that could happen, but I think there are a couple of points I would mention here. One is that if you generally, I mean, our view on the overall sort of India positioning side of things has been that overall foreign positioning is still decently light in India, and because a lot of the price action has been in because of the domestic flows, as we know. And so when you sort of look at the India's overall foreign ownership, that's still at 11-year lows or close to that. So it's a multi-year low still in terms of foreign ownership. When you look at the EM fund positioning or Asian fund positioning, the fact that India's weight in the emerging market benchmark has gone from 8 to 10%, which was the case about 10 years back, to nearly 20% now. People have been sort of chasing that move, and so at the margin, emerging markets are like less than 100 basis points overweight, which is much lower than what they had historically. And Asian mutual funds are actually slightly underweight India based on the numbers we track, right? So my broader point being, it's not that people have been super overweight India to begin with. And yeah, there could be a trimming of some allocations, which we have seen in the past. But a lot of the overweights we see technically have also been in banks, which have obviously derated quite a bit and underperformed quite a bit. And so beyond banks, we don't see a lot of concentrated overweight positions in a lot of the names within the FII bucket. And so therefore our sense is that even though there might be some sort of rotation, we don't expect a large foreign selling in Indian markets.
Sunil, hi, afternoon. Getting back to that point on China, the two recent episodes you indicated in January of 2024 and even towards the end of 2022, when we had those sharp China rallies of 30 and 60% respectively, they were short-lived. They were tactical in nature to some extent. Is it going to be the same this time too? That, that up move in Chinese markets continue, but it's not that like we're at the start of a structural bull run in China. So do you think the measures also that have been announced so far, the coordinated response, is enough to get them out of a slump and start a bull run for the Chinese equities?
Look, I mean, that's a great question. Our sense still is that you got structural challenges in China in terms of slowing growth and sort of weakening demographics. I mean, the property overhang is real. I mean, what they are doing is a lot of the supply side measures in terms of putting more more money in people's hands, and then at the margin, easing some measures in terms of people sort of buying properties. A lot of the austerity measures they have put on property, they have kind of the Chinese policymakers are removing that. But I think it still needs to be seen whether that's enough for stimulating demand, right? I mean, these are kind of more measures on the supply side. There hasn't been enough that has been done on addressing the high inventory we are seeing in the real estate market. So I think there still will be some drag from the property market on the growth, but so far what had been happening is that growth estimates had been coming off. All the higher frequency data was continuing to weaken, and there was a downside risk to a lot of the numbers on the street in terms of government not able to meet even their 5% GDP growth target, which they had And I think what these measures are doing, they're at least putting a floor on those numbers, and hopefully they should be able to at least meet those numbers. So I think to your point, we don't think it's a start of a structural bull market in China. We still think that there are structural challenges to the growth. But I think a lot was priced in the markets already, with both positioning and valuations at cyclical lows. And so I think what's happening here is that you're kind of taking out the left tail risk out of the market, which is why the market's now re-rating from very low levels. And so that momentum, as I said, could sustain. But then I think the market will need more evidence that A, higher frequency data is indeed kind of stabilizing, if not improving, and B, you should start to see, hopefully, that in the corporate earnings side of things, because I think the reality still remains that if you look at the second quarter numbers, like the June quarter, or for the first 6 months of the calendar 2024, the aggregate China universe, which is around 6,000 odd companies, the aggregate profit growth was 0%. So we had no aggregate profit growth. Obviously, dispersion within sectors, but literally no profit growth for the first 6 months of the year. And most of the sectors, barring internet and a few pockets, were actually still seeing earnings downgrades. So I think we need to sort of move from higher frequency data still weakening, earnings still sort of seeing downgrades, to hopefully things kind of stabilizing. And I think that will give markets some comfort. But I think we are far from calling it a structural bull market in China at the current levels.
All right. Hi, Sunil. Good afternoon and good to see you, Ben. Well, that's the reason that India trades at a sharp premium in comparison to China, right? We have earnings growth, political stability out here, and, things have been looking up out here. So better stability, it could be one of the factors that, that's why we are commanding those valuations. We've spoken enough about China. Let's focus on, sectors and themes. Now, we're talking about global-facing themes, and two of them stand out. One is metals, where I think you'll had a neutral stance. So with this kind of rally, and if China's going to come back into play, then will you all want to change that stance out there? That's on metals. And what about tech? You all were bracing yourself for a far better second half of the year. Holding on to that thought?
Look, I think on the metals, we still, Nigel, have a market weight stance there. Again, I think sort of if you circle that to the China discussion, also, we don't think this is a huge demand upside for the commodity complex at this point in time, as we spoke about the property market. So I think we still think that for the metals overall, some of the metals, whether it's steel, whether it's iron ore, they're kind of still structurally oversupplied in many of the global markets, including in China. And so I think keeping that in mind, we still think that that the neutral is probably the right stance in there, rather than being sort of overly bullish on metals. On the IT side of things, I would say we had been warming up on the sector, and kind of we had been not structurally, but we have been underweight for most of last year. And sort of coming into this year, we had sort of neutralized that stance largely on the fact that even though you have a couple of more quarters of weakness in near term, you could start to see inflection into the outer quarters. And I think that is starting to play out. But having said that, we still think it makes sense to be much more geared towards the domestic sectors in India overall. And we have a sort of mix of both cyclical and defensive sectors in our allocations. And I think one of the core views, which we just reinforced or reiterated in a detailed note published last week, is that overall we feel that India's profit growth is sort of its sensitivity to the external growth has been coming down. It's kind of much more geared towards domestic growth, and that is already kind of reflecting in the profit pools being shifted. So in the last sort of 8 to 10 years, most of the bulk of the profits were literally coming in from sort of financials and IT, and I think that's kind of shifting already towards some of the investment cyclicals, which includes kind of autos, real estate, power, some of the clean energy side of things, and that's where our sort of positive views have been around. And we do think that over the next not just sort of the next few quarters, but on a more medium-term basis, it makes more sense to be more geared towards the domestic cyclical sectors in the market, and that's where most of the profit growth will come from, and that's which will show up in the underlying stock prices as well.
Okay, so you're sticking to your sort of like for domestic cyclicals, and just another 20-30 seconds left on the conversation, Sunil. What about earnings? It's at the end of the day, earnings are the fuel that power sustained bull markets, right? We're getting into another season. How confident are you about the earnings delivery, and what's the range, say, for the Nifty 50? For your own universe, what's the rough earnings growth that you're still penciling in this year?
Yeah, so if you look at the last 5 years, Surabhi, so we have been sort of, I mean, obviously a lot of volatility with the COVID drawdowns and all, but the last 5 years, MSCI India has basically compounded earnings at 16% CAGR rate. We are sort of penciling in. So the first 6 months of the year, we have around 14% earnings growth. So still kind of numbers coming through. And I think to Nigel's point, the view really is about macro very good, earnings delivery continuing, and then domestic flows kind of supporting the market. Our own sense is that going forward, you can still see mid-teen earnings over the next sort of few years until 2020, 2030, where we have sort of official forecasts out now. And we are up sort of penciling in around 14% earnings growth. So somewhat slower trajectory than what has been in the recent years, part to do with the signs of slowdown in the economy and sort of fiscal consolidation that the government is doing, which might sort of weigh on the growth. But in general, we still feel confident that you could see around 14% earnings growth over the next sort of 4 to 6 years, which sort of should drive markets higher, even with some multiple derating from current levels. So you could still see decent sort of early double-digit returns in the market on a sustained basis. We still have a 27,500 target on Nifty, and we are overweight the market in the context of the region.
27,500 by when, Sunil?
I mean, obviously the markets have been stronger, so that's a 12-month target technically, but it's basically kind of 7-8% upside, which is 13-14% earnings and a bit of multiple compression is how we get to that number.
Okay, Sunil, it's always good hearing your thoughts. Thanks a lot for speaking to us here on CNBC TV18. China, it may be bouncing, but it still has structural issues. India will continue to see a mid